Good morning, everyone. My name is Patrick Edsenga. I'm going to be our sort of host slash moderator today for the panel that is going to be discussing a deeper dive into unemployment and other benefits for employees who have been laid off or furloughed because of the COVID-19 pandemic. Presenting with me today will be my partners, Mark Campbell, Jeff Gray, and Tripp VanderWal. I guess quickly, just a little background on how this webinar came together and a little bit of the state of play, if you will, on where things are as of this morning. So obviously layoffs are on top of everyone's mind at the moment. Some of the estimates on the jobless claims that people believe will be reported when the numbers are released Thursday are as high as 3.4 million jobless claims will be made this week, which is going to be a record and then some. So with that being on the top of everyone's mind, what we've been hearing from a lot of our clients is employers are concerned about their employees. They don't want to just cut them loose in this, incredibly troubling time. They want to make sure that they're as whole as they possibly can be. And so we were getting and continue to get a lot of questions about what are ways we can help our employees beyond just them receiving unemployment, obviously. And so that's what this webinar is going to be about, certainly explaining all the unemployment benefits that are going to be available to employees, but also what are some other ways that employers can help their employees as they're laid off or furloughed to get through these tough times. And one of the big wrinkles in our webinar is late last night, there apparently was agreement reached between the Senate and the White House on a $2 trillion stimulus bill. It's supposed to be voted on later today, hopefully going to be signed by the end of the week. As of this morning, we have not even seen the text of that bill yet, so we're just relying on public reporting on what may be in the bill. So we're not going to be able to offer specifics, but a few of the things of note in the bill are a $500 billion fund to lend to corporations who are in trouble, $150 billion to loan and provide to state and local governments, $130 billion to hospitals, some direct payments to individuals, nearly $400 billion in small business loans, and then most notably for this presentation, potentially beefed up unemployment insurance for employees who are furloughed or lost their jobs because of COVID-19. And at least according to the reporting at this point, the goal is to make people whole 100% of their income for up to 4 months. Although obviously we anticipate there might be some caps in there. At least a lot of people, the goal is to get them 100% of their income. Another thing that came out yesterday is guidance on the Families First Coronavirus Response Act from the Department of Labor. Many of our questions were not answered. We anticipate those will be answered when they issue more guidance and regulations. But one thing to note is they announced the effective date of that act. Previously, everybody had been under the assumption it would be April 2. It will be taking effect on April 1. We're going to be releasing a client alert on that and other aspects of the guidance today. But it's important to know that it goes into effect on April 1. Okay, and with that, I will turn it over to our panelists. Mark Campbell will be talking first about unemployment.
All right. Thank you, Patrick. I want to welcome everybody today. I appreciate you taking the time to spend about an hour or so with us and go over these issues. I will do my best during the course of this webinar to answer as many questions as I probably can. I'm sure, as you will all find out very soon, I'm not the most technologically savvy person out there. So as far as answering questions, typing while I'm presenting, that probably is not going to happen. But what I will do is, as the questions roll in, I will try to get to as many of them as I possibly can. What I'm going to talk to you about today is unemployment benefits. I'm going to give you some general information about how those benefits work. We've received tons and tons of questions from our clients about unemployment benefits, I'm also going to talk about Executive Order 2020-10, which is, I think it was passed sometime last week, and it was an expansion of unemployment benefits in the state of Michigan. The governor entered that executive order. I'm also going to talk a little bit about work share programs. This is something that has come to the forefront during these times. Not a very common thing. It's something that we don't see too often, but it could be useful in this situation. So we'll talk about those as well. Patrick, if I could get the next slide, please. So let's talk about some general information regarding unemployment. One of the big questions that I get frequently is, when should employees apply? Is there a waiting period? Do they have to wait 1 week, 2 weeks, 3 weeks before they apply? And the answer to that is apply immediately after they're laid off. As soon as we let them know that you are laid off, furloughed, or even reduced hours can get you some unemployment benefits. As soon as you find that information out, employees should apply for unemployment. There's no reason to wait to apply. The governor did extend the deadline for collecting back unemployment, but there's no reason to wait. Now, that being said, simply applying for benefits does not mean you are going to get a payment from the unemployment agency. Once somebody files a claim, you'll receive in your MIWAM account, which is your Michigan Web Account Manager, we call it MyWAM. You'll receive something called a monetary determination. That lets you and the employee know whether or not they are eligible to receive benefits. It contains their amount of their benefits, and it lets them know that how long those benefits could potentially last. But once you get a monetary determination and right after you apply for unemployment, that doesn't guarantee that you're actually going to get money in your bank account. In order to do that, you have to certify for benefits, and that is done biweekly. So after a 2-week period of unemployment where you have not been employed, then the unemployed individual will have to certify for benefits. They can do that online by answering a series of questions. They can also do it on the telephone through a system that we call Marvin. And basically, you either call up or you go online, you answer the questions, and if you answer all of the questions correctly, questions such as, are you seeking work? Are you available and able to do full-time work? Those types of things. If you answer those all correctly, then you have certified for that week, and you will get a check that contains 2 weeks worth of unemployment benefits. So another question that we received a lot this week is, how long before my laid off workers get money in their pocket? And that answer is about 2.5 to 3 weeks after the layoff. They should apply immediately, the same day, the next day, as soon as possible afterwards, but they will not receive any type of a payment until they certify for that 2-week block of benefits. So once you certify, fairly quickly after that, money should be deposited in their bank account, or they will receive a debit card that gets loaded with the benefits that they can use just like a credit card. But there is at least 2.5 to 3 weeks from layoff until your first benefit payment. And the next issue is, eligibility. Is somebody eligible to actually receive these benefits? Now, that is something that we do not determine as employers. That is determined by the Unemployment Insurance Agency. What they do is they go back and they look at the wages that somebody has earned over, let's say, the last 1.5 year period, which we call the base period. And people have to earn certain amounts of wages during that period in order to be eligible. That almost universally is things that we do not have access to. So it's the UIA who determines whether or not somebody is eligible to receive benefits. If you have been a fairly regular worker, even a part-time worker, over the last 1.5 years or so, you are probably going to be eligible for benefits. So there's really not too much of a concern for that. Patrick, can I get the next slide, please? Now, a big question is, how much are the employees going to receive? Again, I wish I had a better answer for you, but that is not something that we can calculate on our own. That takes into account all of the sources of income that somebody has had over the last year and a half. And some of that may have come from us, some of that may have come from other sources. So it really is hard for us to figure out exactly what somebody is going to get. But generally speaking, the state minimum unemployment benefit is $81 a week, and the maximum benefit is $362 a week. Now, if we're dealing with a full-time employee, somebody who has generally worked full-time over the last year and a half, they are going to be on the higher end of the spectrum. Let's say somewhere around $250 to $362 a week. If somebody was only part-time, does not have a lot of wages during the last year and a half, they may qualify for a smaller benefit. But your average full-time worker is going to be on the higher end, $250 to $362 ballpark. Now, how long is this going to last? Normally, unemployment benefits last 20 weeks. We reduced it several years ago in the state of Michigan. Under the governor's executive order, they have been increased back to 26 weeks. So the benefits could last up to 26 weeks. But it's important that if you're talking with your workers who are going to be laid off or are on layoff now, make sure that they know that you have to certify for benefits. They will receive a schedule of when to certify for benefits from the Unemployment Insurance Agency. Make sure that they stick to that schedule, because no certification means no money, period. So make sure that your employees know that they do have to do that. So stick with the program, do what the UIA tells you to do, certify, and you will receive your unemployment benefits. Another issue that we talked a lot about is there anything we can do to make this easier on our employees as far as claim administration issues? One thing that you can do is you can go on your MyWAM account and you can file what we call a waiver of seeking work. And basically what that means is if this is intended to be a short-term layoff of 45 days or less, what the law says is that the individual actually doesn't have to be seeking work. Normally, you have to be seeking work in order to collect unemployment benefits. But if it's a short-term layoff expected to be 45 days or less, they can waive that requirement. And as employers, if we go on to our MyWAM account, we can file a waiver of the seeking work requirement. And once that is on file, then our employees no longer have to worry about that seeking work requirement. So that's one thing that we can do to help our workers that are on layoffs. Another issue that, one good guide that we have seen, the agency came out with Fact Sheet 160, which is the COVID-19 Guide to Unemployment Benefits. I recommend that everybody take a look at that. If you search on the internet for Unemployment Insurance Agency, Fact Sheet 160, it will come up. That has very good information. That's something that I think everybody who is dealing with the unemployment claims on the employer side should take a look at, as well as sharing that with the workers that are laid off or about to be laid off would be an excellent idea. Now, as for some other questions that are rolling in that I'm seeing is part-time employees. Can part-time employees collect unemployment benefits? Yes, they very, very well could be entitled to some benefits. If you have a part-time worker that's laid off, if they're otherwise eligible for benefits, which means that they've made enough money, and as a part-time worker, they probably have, they still can apply for and receive benefits. So there's no distinction about whether somebody's a full-time employee or a part-time employee for unemployment benefit purposes. If you've made enough money over the last year and a half, then you can be eligible and can collect benefits once you are laid off. The next question that we get a lot is, when you receive a monetary determination, it's going to have a number on it that shows your maximum charges. For a max rate individual, you're looking at, for 26 weeks, you're looking at $9,412. You'll see that number on there. I get a lot of calls from employers who say, I can't write a check for $9,412 to the unemployment agency for every single one of my workers. And the good news is that you likely do not. Most employers out there, private employers, are contributing employers, which simply means that you pay taxes. The taxes that you pay on a quarterly basis, those are the things that are used to fund the unemployment system. So while your account will be charged, which we refer to as your experience account, that doesn't mean that you actually have to write a check dollar for dollar. So when you see the monetary determination that shows potential liability of $9,412 for every worker, there's really no reason to be too concerned about that. Those could be the potential charges that are on your account as a contributing tax-paying employer, but that doesn't mean you're going to have to turn around and write a check for that amount. But with all those charges on your account, what that does mean is that your tax rate probably will go up as a result of this. But that's just the nature of the system and how it works. Now, for public sector employers out there or nonprofit employers who've elected to be reimbursing employers, when you receive the monetary determination that shows over $9,000, does that mean that you'll have to pay $9,000? Well, technically, yes, unless there is some reason out there where your account will not be charged. They call that non-charging your account, and which we will get into in a little bit. The governor's recent, there was the governor's 2000, let me see, it was Executive Order number 10 regarding unemployment. Paragraph 6 specifically indicates that employers, let me locate that here. An employee unit must not be charged for unemployment benefits if their employees become unemployed because of an executive order requiring them to close or limit operations. So this could be good news for all employers. 2 days ago, the governor issued the stay-home order, which required lots of employers to close their doors. It likely required every single employer to limit their operations. So based on my interpretation of paragraph 6 of Executive Order 10, I believe that anybody who has been forced to either limit their operations or close their doors due to the governor's stay-home executive order should not be charged for benefits. And we will get a little bit more into that later on. Can I get the next slide, please? All right, so the executive order that came out last week that impacted unemployment benefits had some pretty new and groundbreaking information in there. Generally speaking, for unemployment, if somebody voluntarily leaves their own job, they usually are not eligible for unemployment benefits. They are disqualified from receiving them. And what the executive order from last week stated that is, if somebody voluntarily leaves due to COVID-19 issues, then essentially that is going to be an involuntary leaving, which means they still can get benefits. So if someone left work because of self-isolation, if they're immunocompromised, if they were experiencing symptoms, if they had contact with a confirmed case, if they're caring for a family member due to COVID-19, or anything essentially related to COVID-19, it's going to be deemed to be an involuntary layoff. It doesn't mean if they left, they could call you and say, I am not coming into work anymore because of this. Normally that's a voluntary leaving and they would be disqualified from unemployment benefits. Not during this COVID-19 situation. Basically, anybody who leaves work for COVID-19, it's going to be deemed to be an involuntary layoff, and it does not disqualify them from receiving benefits. Can I get the next slide, please? All right, the governor's executive order increased benefits from 20 to 26 weeks. And paragraph 6, which I think is very important, especially for your reimbursing employers out there, you have to pay dollar for dollar for these benefits. So this could potentially be a lot of money. But the good news is that paragraph 6 states that employers must not be charged for unemployment benefits if employees become unemployed because of an executive order requiring employers to close or limit operations. And the recent stay-home order, I believe, as far as my interpretation is that it's going to require everyone to limit their operations. So I take the position that no one should be charged for any benefits for any employees after that stay-home order was issued the other day. So that will be good news. You're reimbursing employers. You're going to want to keep a close eye on this. I know the executive order says that we shouldn't be charged if our operations are limited by executive orders, but that doesn't mean the unemployment agency is not going to charge you. I would keep an eye on your claims. I would keep an eye on your UIA 1136 forms, which are your benefit charges, and see exactly what you are being charged for on your account. Reimbursing employers, don't be surprised if you receive invoices for benefits. I know that the executive order says you probably shouldn't be charged because your operations were limited by the governor, but I don't necessarily think that the UIA is voluntarily going to do this. My educated guess is that you're going to continue to get bills, invoices in the mail saying you owe this much in reimbursements on your employees. And then you're going to have to take it upon yourselves to deal with the UIA and let them know that we're not required to pay this. Our operations were limited or closed because of the governor's stay-home order. Therefore, under Executive Order 10, we should not be charged for this. And I recommend that everyone keep an eye on that. In a perfect world, you simply wouldn't get a bill from the unemployment agency because they know that you shouldn't be charged. But after dealing with the agency for about 20 years now, I bet that you probably will get something. So keep an eye on that. You're probably going to have to take some affirmative action in order to make sure that your account doesn't get charged or they don't expect you to do reimbursements. All right, can we get the next slide, please? I've had a lot of questions on work-share programs. Work-share programs have actually been around a long time. They are not too popular, but essentially work-share programs are sort of the alternative to completely laying people off. Instead of laying off, let's say, half of your workforce and simply completely laying them off and putting them on unemployment benefits, if you create a work-share program, what you do is reduce everyone's hours. You keep people employed, but you reduce their hours a certain percentage, which means you are saving money on the labor cost. But if you have a work-share program, those employees, even when they're working reduced hours, still will be able to get a portion of their unemployment benefits. Work-share programs do have their advantages. I mean, they help retain your trained and skilled employees. Eventually, we're going to get through this. And we do not want to be at square one having to train everybody all over again. If you have a work-share program, people are still involved. They're at the workplace, and it helps you retain your trained and skilled employees. And it makes it a lot easier to recall them because they're always there, at least working some during this. Can I get the next slide, please? So an example of what the employee can receive under a work-share program Let's say an employee is receiving a $360 a week rate from the unemployment insurance agency. And if we reduce their hours by 20%, then the employee will receive his or her pay plus a work share benefit of $72, which is basically 20% of the normal $360 weekly unemployment benefit. So they're still working, they're still getting a partial paycheck from us, and they're also getting a supplement from the unemployment agency to cover, doesn't completely cover the shortfall, but it's better than nothing. So the employee can still get a paycheck and also get a supplement from the unemployment insurance agency. Can I get the next slide, please? Now, under a work share program, they do have their drawbacks. Employee work hours cannot be reduced by more than 45%. So if you need to cut hours by 50%, then you will not be able to do a work share program. Now, work share programs apply to full-time employees. Part-time employees cannot be part of the work share program units. One good thing about work share programs is you can create multiple work share units within your organization. So you can have your shipping employees be one work share unit. You can have other employees in other areas be a different one. So there is a little bit of flexibility. These programs are generally approved for a year long, but you can stop them anytime you want. Work share programs generally, they work well and for sustained economic downturns. If the business is taking a hit and it's expected to be down for quite some time, creating a work share program is a very reasonable way to deal with that downturn. Unfortunately, work share programs do not work well in emergency type situations. In those situations, you need to maintain flexibility. You need to be able to, cut wages by 75% if possible, cut the workforce by 50% or more. The work share programs just don't allow you to do that. So while they're an excellent idea, and if it is feasible, you may want to give that a shot. But in situations like this, work share programs are not too realistic. But if you can make it work, it's a good thing that you can do for your employees because they stay employed, you keep them in the workplace, and they still get some benefit from the state government. On the slide, you can see there's a number, 844 work share to call. I've got a number of complaints from clients who have said, we've been trying to establish this for a week and a half now, and we have not heard back from the unemployment insurance agency. That is fairly common. Really now, I think the unemployment agency is severely understaffed, and they're not really capable of fully administering the work share program right now. So if you think this can work for your organization, I recommend that you look into it. Don't expect something to be done immediately by the UIA. I simply don't think they're staffed to handle the volume right now. All right. Another big question as we've had is that I want to pay people some money while they're on unemployment. I want to make sure that I try to keep them as whole as possible. If I pay them money while they're receiving unemployment, will that impact their unemployment? And in most cases, the answer is yes, absolutely. That doesn't mean that it's going to completely eliminate their unemployment benefits. But if you just simply pay a bonus, a weekly bonus of $300 every week during a layoff, the employees by law are required to report that as earnings. Any earnings that you have during your weeks of unemployment must be reported to the unemployment insurance agency, and those earnings will reduce your unemployment benefit accordingly. If we end up paying somebody 1.5 times their weekly benefit amount or more, then their unemployment benefit will be zero of that week. So if we're talking about a max rate worker with a $362 a week benefit, if they earn $543 during that week of unemployment, then their benefit goes to zero. And also, importantly, they use up a week of eligibility. So if we have somebody making $362 and we pay them $543 during their first week of layoffs, and they apply for benefits and report that they have earned $543, then they're going to get $0 that week, and then they will only have 25 weeks of available benefits. Now, if they earn less money, then they can and will receive a benefit from the unemployment agency, but it's going to be reduced. If you see on fact sheet 140, which applies to underemployment, can I get the next slide, please? It shows the calculation here. So essentially, if you made more than 1.5 times your weekly benefit amount, it's going to be zero. If you earn less than 1.5 times that amount, but greater than your weekly benefit amount, then your total earnings are subtracted from 1.5 times your weekly benefit amount. And then if your earnings are equal to or less than your weekly benefit amount, then 50% of your earnings are subtracted from your weekly benefit amount. So the take-home message is that you can pay people some money while they are on unemployment, but it is likely going to reduce their benefits from the unemployment insurance agency, and it could eliminate them. We've had some questions about, part-time employees, and when their hours are reduced, somebody's hours are simply reduced, but they're still continuing to work part-time. Can they get unemployment? They could. They very well could. It just depends on how much you are continuing to pay them on a part-time basis. If this is an employee that's getting paid, $25 an hour, chances are, if they're still working 20 hours a week, they're going to make too much money, and they would not be able to collect unemployment benefits. So while it is possible, it just depends on how much they are making on a weekly basis. Can I get the next slide, please? Now, there's one surefire way to pay employees additional money while they are on layoff and have it not impact their benefits. There's one way that is specifically stated in the Employment Security Act. It's called a Supplemental Unemployment Benefit Plan, a sub-plan as we call that. That is the only way that you can guarantee that your employees will still receive their full amount of unemployment benefits, and you can pay them some extra money to help them get through this difficult time without impacting their benefits. And I think at this point, I'll probably turn this over to Tripp VanderWal, who's our expert on sub-plans.
Thank you, Mark. This is Tripp VanderWal. I am a member of Miller Johnson's Employee Benefit and Executive Compensation Group. And I'm going to start talking, as Mark indicated, about sub-plans in general, and then between myself and my partner, Jeff Gray, who is also a member of the benefit group at Miller Johnson, we will talk about some other employee benefit arrangements that may be able to be used to alleviate some of our employees' financial burdens during periods of layoff or leaves of absence. So
To subplans, as Marcus indicated, a subplan is designed to supplement an individual's state unemployment benefit. So, as you probably are aware, if an individual applies for and receives state unemployment benefits, the amount of the state unemployment benefit that the individual receives will likely be less, if not significantly less, than the employee's take-home pay had the employee continued working. So a subplan allows an employer to supplement an individual's state unemployment benefits to reduce some of that financial burden. The added benefit of that is an employer can potentially make an employee whole with respect to their take-home pay and offload some of its wage burden onto the state unemployment system. The other added benefit of subplans is that if they are properly structured, they are not subject to the employer or employee. I'm sorry, that's what I should say, employer or employee portions of FICA or FUTA taxes. Next slide, please. So before I do have an example on the next slide of showing you exactly some of how the savings that can be realized under subplans, but I guess very briefly, what does a subplan have to do, or what requirements does it have to meet? Generally, eligibility must be limited to individuals who are involuntarily terminated and are eligible to receive state unemployment benefits. I get a lot of questions about whether we can provide a sub benefit to someone who maybe not involuntarily terminated, but placed on a furlough or a leave of absence. And I will tell you that there's not a lot of clear guidance on this. In traditional times, outside of this COVID-19 pandemic, the answer was probably no. The reason for that is without an involuntary separation except in unique circumstances, and Mark covered a few, an individual is probably not eligible for state unemployment benefits unless they had an involuntary separation of employment. Also, with respect to the FICA exemption, the IRS frequently looks to whether an individual is eligible for, and even better, actually receiving state unemployment benefits. So without a separation of employment, if that made the eligibility or receipt of state unemployment more difficult, it was less clear that the FICA exemption applied. I would say the COVID-19 pandemic changed the rules on this because, as Mark explained in his presentation, that even employees whose hours are reduced can potentially be eligible for and receive state unemployment benefits, especially if that reduction or layoff is due to Governor Whitmer's executive order limiting people from working at their work premises. The other requirements is a subplan is an ERISA covered plan. So if you are an employer that's subject to ERISA, which is essentially any employer other than governmental agencies or church employers, we have to satisfy ERISA's requirements with respect to a subplan. So that means that the subplan must be maintained using a written plan document. A summary plan description must be prepared and distributed to participants. And if there's at least 100 participants, Form 5500 must be filed for the subplan. At Miller Johnson, Jeff and I have been working diligently to prepare a template combined plan document and SPD that we have found can be pretty quickly tailored to a specific plan employer's sub-plan design, so we can get the documentation requirements satisfied and up and off the ground quickly. So if this is of interest to you, you can reach out to either Jeff or myself. Moving on to the next slide, Patrick. Here is an example of using a subplan, here is an example of an employer trying to supplement an employee's take-home pay 100% without the use of a subplan, and therefore assuming the employee would not be eligible for any state unemployment benefits. So really what we see here is that if their gross weekly pay is $1,000, if you adjust that only for the FICA expense, really it costs the employer $1,076.50 to provide the employee with take-home pay of $923.50. But if we move to the next slide, we can see the cost savings example of trying to continue this arrangement using a sub-plan. So in this example, we still see we're trying to match an employee's take-home pay of $923.50, but using a sub-plan, we can offload at $362 of that wage expense, which assumes that the individual is eligible for the maximum state unemployment benefit. And then the sub-benefit only has to cover $561.50. Since these sub-benefits are not subject to FICA, FICA is no longer an issue. So in this example, the employer's wage expense drops to $561.50, and the employee's take-home pay remains the same, which is a savings to the employer of $515.50. It is important to note that an employer doesn't necessarily need to try to continue 100% of an employee's take-home pay. That percentage is flexible, could be dropped to 90%, 75%. So that will result in additional savings to the employer. Of course, the employee will not recognize the same take-home pay as they would have if they had continued working. Next slide, please. So another question we're getting, or another issue we're getting a lot of questions about is PTO donation programs. So a PTO donation program allows one employee to donate PTO to another employee who may have exhausted their own PTO but need to take additional time because, for example, they may be under quarantine or more adversely affected by the stay-at-home order. So under the IRS's general rules of assignment of income, this is getting pretty technical, but I'll try to cover it quickly here. An individual may not assign taxable income to another individual to avoid the tax consequences. So that same concept applies to PTO. If I'm entitled to PTO, outside of certain circumstances or certain exceptions, I can't donate that PTO to another employee to avoid the tax consequences, which would mean applying those rules, if I wanted to donate PTO, I would be taxed as though I took the PTO subject to state and federal income tax, FICA tax, and the donee employee would take that donated PTO on a tax-free basis. Under PTO donation programs, there's exceptions for medical emergencies and certain disaster relief leave sharing programs, which changes the tax rules on this. And this, under the changed tax rules, the donor employee can donate PTO time on a tax-free basis, so it's not taxable compensation to the donor employee, and instead it's taxable to the donee employee. The way these generally work is the number of hours that are donated by the donor employee are multiplied by the employee's base rate of hourly base rate and converted into an amount, and then as that amount is taken by a donee employee, it's divided by the donee employee's base rate of pay, so that it is adjusted appropriately. Let me point out one thing about whether we can use these PTO donation programs in light of the COVID-19 pandemic. The little IRS guidance that we have on these issues actually makes these arrangements permissible in medical emergencies and under major disasters declared under by the President under the Robert T. Stafford Act. While some states actually have a major disaster declaration in place now, I believe those to be New York, California, and Wisconsin, some of the states that have been hit harder through this. Michigan does not have a disaster declaration. We have a public emergency declaration. So it's unclear if a PTO donation program, at least a tax-favored PTO donation program, is permissible in Michigan right now. But reading between the lines of the IRS guidance, I think employers that want to move forward with these arrangements would have a defensible argument that for this purpose of public emergency, there was no difference between a public emergency and a major disaster. With that, I'm just going to kick it over to my colleague Jeff for just a second to talk about the Section 139 disaster relief programs, and then I'll take it back and cover some other benefit issues.
Thanks, Tripp. Good morning, everybody. Like Tripp said, I'm Jeff Gray, and I work in the employee benefits group at Miller Johnson. I'll talk a little bit about these disaster relief payments under Section 139, kick it back to Tripp to talk about health and welfare, and then I'll wrap it up at the very end with a little bit of information about retirement plans. So let's talk about these disaster relief payments. As Tripp was saying about the PTO programs, it's a little unclear sometimes whether we've got a major disaster or an emergency order or what. But for purposes of these Section 139 disaster relief payments, we just need a federally declared disaster to kind of open up this potential relief. And we do have that for Michigan now. The emergency order that was issued on the 13th by President Trump qualifies as a federally declared disaster for purposes of the section of the tax code. And so this section is really kind of a marvel of simplicity compared to what we normally deal with. Under this section, basically once we have this federally declared disaster, employees who receive payments for reasonable and necessary personal, family, living, or funeral expenses can get those payments basically on a tax-free basis from whatever source. So in this case, if the employer decides to make a reimburse or make payments for those items, it can do so really on a tax-free basis. It's not subject to income tax, it's not subject to employment tax, but there are some limitations. The biggest limitation is that these payments have to be reasonable relative to the size of the expected covered expenses. So if you've got expenses that fall within those fairly broad categories, right, personal, family, living, those are pretty broad categories, the payments still have to be reasonable relative to the expected size of those. Another limitation is that the payments really cannot function as income replacement, so they can't kind of work as a monthly stipend or a weekly stipend or something like that. When the IRS has considered these types of payments in the past, it's done so in the context of more like a grant program. So the employer may establish we would recommend having some kind of a written program document that kind of outlines the parameters of this type of a relief payment. But it's more often like just a flat grant payment based on need. The interesting thing about these payments is that, unlike in other situations, the employees don't need to substantiate their expenses, meaning provide receipts. You could certainly ask for that. It would make sense for that if you were to do one of these programs, but they're not technically required to do it under the IRS rules that apply to these programs. The payments themselves, though, they cannot be payments for anything that would be covered by insurance. So those don't work. You can't reimburse those. Or, just general income replacement. Like I said, it can't function in that way. You don't technically have to have a written program to even do this. It would not be an ERISA plan, but we recommend that you would have a program and probably some sort of application process just to make it clear for people. Let's see. In terms of, Marcus explained pretty clearly that if you pay people earnings, those earnings could potentially offset or impact their unemployment benefits. We've done a little research, and it looks like, at least in our view, these payments probably would not count as remuneration under the unemployment statute in such a way that would affect their unemployment benefits. If you go through and you read the list of items that employees are asked when they certify for unemployment, this really doesn't fit on the list, right? UIA asked about severance, it asks about bonuses, others that asked about earnings received. This really is intended more like what it's described as, a disaster relief payment. And even if it could potentially be remuneration, we think there's some opportunity to even kind of allocate this payment, if you wanted to another week. For example, sometimes employment lawyers for employees will say, hey, I know you're paying severance to this person. We don't want that to count against their unemployment. Can you allocate that to their last week worked when they weren't receiving unemployment? And we think we can do that same thing here with disaster relief payments if it came to that. So that's an overview of disaster relief payments. I'll send it back to Tripp.
Thanks, Jeff. I'm seeing a number of questions coming about subplans. We will try to address some of those as time permits after this. But one of the other big questions I've been getting from employers of all sizes is what about health and welfare benefits when I put my employees on a leave, furlough, or layoff? And I think, first of all, we have to bifurcate between whether the status of our employees will actually be a termination of employment, or if they will be put on some type of leave or reduced schedule or during this period. If the employment relationship is actually terminated, then I think employees' eligibility for your group health and welfare benefits will terminate as it normally would for a terminated employee. So if, for example, you have a last day of the month provision for your health plan and you terminate your employees during this period, coverage will continue until the end of March, and thereafter COBRA must be offered. But if instead, if you're not taking the position that the individual's employment is terminated rather than putting on some type of furlough or employer-approved leave, then I think that some further analysis is required. And that's because most health and welfare benefit plans have what we refer to as an actively at work requirement, which requires the employee to be actively working, not just being paid, but actively working a certain number of hours. And if they're not doing that, they lose eligibility for these group health and welfare benefits. So if that is the case, it is prudent to review your plan documents, certificates of coverage from your carriers or SPDs about what it says about benefit eligibility during, I would say, employer-approved leaves of absence. If your plan has such language, for example, many times coverage will be continued for an employer-approved leave of absence for a certain period of time, such as 12 weeks or 3 months. In that case, I think the employees will continue to be eligible for health and welfare benefits during these leaves or furlough periods. And you can certainly require employees to continue to pay their share of the premium. Two of probably the most common ways to do so is one, require an employee to write checks to the employer during the leave period to pay for his or her portion of the premium. Or two is to basically forgive the employee's portion of the premium. Or I guess the third option would be to then charge the employee his or her portion of the premium when they return and are working for you again. All three of those are likely permissible ways to collect employee premiums during these leave periods. If you review your plan document, SPD, certificates of coverage, and you don't have a leave provision, I understand that I did briefly talk about this on a webinar last week, but a lot has changed since then. I understand a lot of insurers are now reaching out to their group customer clients and allowing these insurance arrangements, whether it be a fully insured arrangement or a stop-loss policy under a self-funded arrangement, to be revised to continue coverage during leave periods. So if you want to continue coverage during these leave periods, and it doesn't look like you can do it under your current plan document, certificate of coverage, or SPD, I recommend you reach out to the applicable insurance carrier or stop loss carrier. Next slide, please. So one of the issues that was passed in the Families First COVID Response Act, the FFCRA, last week was information about what health plans, including group health plans, have to cover with respect to COVID-19 testing. So COVID-19 testing is likely covered by most health plans and likely was covered by most health plans before this pandemic, just as typical office or hospital covered services. The federal legislation did indicate, though, that diagnosis, which includes testing and evaluation, must be covered with no participant cost sharing. So when it comes to the diagnosis of COVID-19, we can impose deductibles, co-insurance, or co-payments. And again, keep in mind that this, since it's testing and evaluation, it's not just a requirement to cover testing with no participant cost sharing, it's also evaluation. So my understanding is particularly right now with the limitation on the number of COVID-19 tests we have, many times an individual will call his or her health provider because they have the symptoms or they believe they may have been exposed, and the provider will evaluate them but will not actually perform the test until the symptoms get worse. That is a situation that even though the test was not performed, it still appears to be an evaluation of COVID-19 and would be required to be covered with no deductibles. And just to be clear, this no participant cost sharing is required in basically all settings. So whether the individual receives the diagnosis or treatment in a doctor's office, in an urgent care facility, through telehealth, or even in the hospital itself. With respect to the treatment of COVID-19, though, so if someone is test positive for COVID-19 and requires additional treatment, the treatment is still, again, likely to be covered under a typical group health plan, but does not need to be covered with no participant cost sharing. One other note on this with respect to the waiver of participant cost sharing requirement, the IRS released about 2 weeks ago guidance that said high deductible health plans will not fail to be high deductible health plans if they provide coverage of diagnosis before the high deductible health plan's minimum annual deductible is satisfied. That was a big relief for employers who sponsor HSA, high deductible health plan HSA arrangements, because this will not negatively impact an individual's HSA eligibility. The last issue I'll touch on very briefly has to do with various medical information that you're obtaining from employees with respect to COVID-19. The question I've got is, what if we take an employee's temperature on the way in or out of the workplace? Does HIPAA apply? And the answer to that question is no, because while the temperature is likely to be health information, it is not generated or created by a covered entity under HIPAA. So while it is health information, it is not protected health information. So HIPAA would apply. I understand there may be some ADA concerns, but I'll kick that over to Patrick because I think the EEOC issued some guidance on that.
And that's absolutely right, Tripp. Normally, you would not be allowed to take an employee's temperature because it's considered a medical examination unless it's deemed job-related and consistent with business necessity. However, now, with the declaration that COVID-19 is a pandemic, the EEOC has essentially taken the position that every time you take an employee's temperature, it can be job-related and consistent with business necessity. They put out guidance that said you're free to do that. Two reminders here. One, not every employee who has COVID-19 will necessarily have a fever. And two, make sure you're not disclosing that temperature information outside of people who need to know it, which would be people who are going to be making the decisions as to whether that employee can come to work, should be leaving work, things of that nature.
With that, I think we can move it over to the next slide and kick it over to Jeff.
All right, thanks, Tripp. So I'll finish us up here today. We've got 2 minutes left, but if you don't have a 9 o'clock conference call, you can obviously stay on and we'll keep going. I'll talk a little bit about retirement plan considerations, given all that's happening. We talked early on about some additional benefits that employers can provide to employees, but a lot of the questions we're getting from employers too are, how do we cut costs? How do we eliminate or reduce the employer contribution to our retirement plan, for example? So I'll talk a little bit about that first. In most cases, the employer will be able to reduce its costs in a number of different ways, but the most fundamental point that I can convey is that you really need to review your plan document before you do anything, because in a lot of cases, it will depend on what your plan says, whether you need to amend it first, for example, or whether you can change the contribution just by notifying employees. And that means the actual underlying plan document, not just the summary plan description. But let me give you a few examples. So let's talk about defined contribution plans first. These are 401k plans or 403b plans. If you have a completely discretionary matching contribution, for example, and your plan document describes that discretionary match as discretionary and paid on a payroll period basis, for example, you can probably just stop that additional matching contribution if you wanted to by providing advance notice to employees before the next payroll date, for example. The same probably works for monthly or quarterly matches. You just would need to give people notice ahead of time before you change that discretionary matching formula. If you make a match every year, we'd have to look at it a little bit more closely because we're sort of part through 2020 already, and we want to make sure that any change to that wouldn't cut back any accrued benefits that employees already have under the plan. Some other types of plan designs are a little bit more difficult, though, right? If your plan document says we'll match X amount, we'll match 100% of your pay deferrals up to 3% of your compensation, we'll make that every payroll period. Well, in that case, for example, you'd really need to amend your plan before doing anything else to change that match. And there's also more complication, of course, with safe harbor 401k and 403b plans. There's more limitations about what you can do to change those safe harbor matching contributions during the middle of a year. Generally, you can change those and reduce them or suspend them if you gave the annual safe harbor notice at the beginning, and that notice specifically told people that you may reduce or suspend that matching contribution during the year. If you didn't send that annual safe harbor notice, but you're operating at an economic loss, you could also potentially change this mid-year. If you do that, though, with the safe harbor plan, you have to give employees notice about the change and at least 30 days advance notice before it takes effect. The other complication with that, too, is if you were to change a safe harbor plan like that mid-year, you'll have to satisfy the non-discrimination testing requirements for the plan year. And many plans adopt safe harbor plans because they can't meet those non-discrimination tests. So you want to think about whether you'll pass those if you make that change mid-year. With respect to defined benefit plans and pension plans, those are more complicated. Generally if you still have active plans like that, you could potentially freeze accruals under those plans. But the big issue there is making sure that you give people the required 45-day notice before the freeze takes effect. And that takes a little work to make sure that notice has everything in it that needs to be there and that it's delivered correctly. If you have non-qualified deferred compensation plans with employer contributions, those are usually a little bit more straightforward. Those are almost more like contracts, the plan document. And in that case, usually you can amend that plan to change the employer contribution, again, on a prospective basis. But again, it depends on how the plan's been written. So you always want to check the plan document. Let's see. And obviously, kind of a final word on cost savings. If you're laying people off and you have a matching formula under your 401k plan, the fact that those employees aren't making deferrals will obviously reduce your matching contribution anyway. So it just depends. Employers have different strategies on what they're planning to do. I think some are trying to keep people employed and weather the storm, and part of that is to drop the matching contribution. Others are saying, we don't want to make these structural changes to our retirement plans, so we're going to go through this layoff and see what happens and go from there. Another issue to talk about, in addition to reducing reducing the employer contribution to these plans, is just how do employees get access to the funds? And access to their funds in these retirement plans. And I should preface this with the comment that this is absolutely the worst time to take money out of your 401k account. So, one benefit that you could potentially give to employees, I think, is increased financial advice. If you've got a financial advisor who works with the plan, works with employees, this is a critical time to have them involved to help employees understand what their options are. But in an emergency, people may need to access their funds. So let's talk a little bit about 401k and 403b plans again. If the employee separates from employment, then it's just the normal rules. The normal rules apply. They can take a distribution because they've separated employment. So there's no complication there. I think the more difficult issues are if employees are kind of on a temporary furlough or a temporary unpaid leave of absence, but they haven't really separated employment. They may want to access their funds. So how do we do that? The main option is, there's a number of options. One is taking a loan from the plan. If your plan doesn't allow this, you can amend the plan to allow these loans. That's one option. Another option are hardship distributions. But again, an employee needs to qualify for these hardship distributions under the criteria that are in the plan. Fundamentally, a hardship distribution is available if the employee has an immediate and heavy financial need, and the distribution is necessary to meet that need. Many 401k plans don't follow that generic definition because it would require individual determinations of everybody who applies for hardship. So most plans just follow these 7 safe harbor criteria that are in the regulations because they're a little easier to administer. One option, if you wanted to give more flexibility for employees, would be to amend the plan to allow this general hardship criteria based on the facts and circumstances. Employees can also, of course, take in-service distributions if they're at least over age 59. Again, if your plan doesn't have that, you can add that in-service distribution option, but it would require a plan amendment. And unlike loans and hardships, if you add this plan, you really can't take it out later. Quick note about defined benefit plans. Those plans you typically pay out when employees reach retirement age. Some plans have in-service distributions. Used to be that was at age 62. With the Secure Act, that lowers that in-service distribution age to 59 and a half. So if your plan doesn't already have an in-service distribution option, you could potentially add that. Let's see. For non-qualified plans, there's a different set of rules under a section of the tax code. These are plans, of course, that are unfunded, and they're usually limited to management and other highly compensated employees. They go by different names: deferred compensation plans, supplemental executive retirement plans, top hat plans. There's different names that these go by. And in some situations, you've got executives who have deferred their own income into these plans. And these plans don't hold the money in trust typically, or if it's held in a trust, It's held in a type of trust that still allows those funds to be accessed by the company's creditors. It's really just a kind of contractual promise by the employer to pay the participants compensation in the future. So you could have an executive who says, wait a minute, I've got 6 figures in this deferred comp plan. The future doesn't look good. I want the money now. And unfortunately, there's really not a lot of opportunity under the tax code to do that, to allow that type of a distribution without a significant tax penalty. Section 409A of the tax code governs these types of plans and generally prohibits the acceleration of payment, which means that you can't pay it earlier than its scheduled payment date, unless you incur large penalties. So, but one thing you can do with non-qualified plans is add something called an unforeseeable emergency distribution trigger. And that's similar to a hardship distribution in a 401k plan, but it's a little bit harder to meet the standard under 409A for emergency distributions for unforeseeable emergencies, but you could potentially add that to your plan to give people a little more flexibility. So I'm getting some notes here. That's the fun part about webinars. You get things flashing in your face while you're talking, but people are asking about the stimulus bill that passed last night, or didn't pass last night, but there's the stimulus bill that's floating around out there, and we understand that last night the Senate and the White House kind of agreed on the basic terms of that. It still needs to be passed and agreed upon and go through the House. So there's a lot of steps left for this to pass, but there are some things in that stimulus bill that will make withdrawals a lot easier. There's a general provision in that bill that says you can take basically penalty-free, so it'd still be taxable, but penalty-free COVID-19 withdrawals of up to $100,000 in 2020 without incurring an additional 10% tax penalty if you're under the age of 59 and a half. So that would kind of obviate the hardship rules that I just talked about, and this may become law fairly soon. We don't know for sure. But under these rules, basically, if they become law, they would apply to any qualified individuals. And these are people who've suffered adverse financial impacts due to the coronavirus, due to layoffs, furloughs, quarantines, sickness due to the virus, or having to care for a spouse or dependent who's been diagnosed. And unlike in other situations, here it looks like we'll be able to just rely on the certification from the employee that the distributions are related to the coronavirus. There are a few other provisions in that bill that would be helpful. So, for example, if you take a distribution out like that, the law will allow you to repay that distribution back into the plan. They basically be treated like a rollover into the plan. And you can also spread the taxes on that distribution out over 3 years. There's a couple of provisions in it about loans as well. It would increase the loan limits. So instead of 50% of your account balance or $50,000, it would go up to 100% of your loan balance or $100,000. So it would increase the availability of loans during 2020. And actually, that would just be temporarily increased for 180 days after the bill's passed. There's a 1-year delay on loan payments also that occur after the bill is passed. So if you have loan payments that would under 401k loan payments, retirement plan loan payments in 2020, those would basically be deferred deferred out for a year. Finally, I think there's a provision in there, and again, this bill changes by the minute. It's not actually in the Senate bill that's on the government website, but we understand the latest version of it also suspends all required minimum distributions in 2020. And that's a good thing because nobody wants to force people to take distributions from their plans given the current economic environment. So that's all for retirement plans.
Okay, thank you, everybody. We will do our best to keep on top of the developments in the latest stimulus bill, and there will surely be webinars coming out about that and its impact on you and your employees. And Apologies for anyone whose question we were not able to answer on this call. You can please feel free to reach out to any of us or to any Miller Johnson employee or lawyer that you work with, and we will do our best to answer your questions. So thank you for tuning in today.